everyone, welcome back to the channel.
Welcome back. If you guys are new to this channel, we talk about a lot of things when it comes to personal finance, our personal finance, investment, property, saving, budgeting, anything's got to do related with money and things that we do in a regular basis in order for us to be
financially free in Sydney with 2 young kids.
At the time that this is recorded, our children is with the age of 5 and 4.
Oh, good, you remember.
Well, turning 5 and 4, or is it turn?
Already 4 and 5.
Already 4 and 5.
And 6-ish, yeah.
So, in today's video, I had a conversation yesterday regarding property. Somebody actually asking me, doing the things that we do, can you, some people would like to invest based on capital growth.
In terms of property investing.
Yeah, in terms of property investing, capital growth, which is what I guess you did that as well.
Yeah,
we did that. However, after a while, if circumstances change, we change our
strategy.
Yeah, into cash flow instead.
Well, just basic concept. So when you invest in property, there are 2 kind of return that people were talking about. One is capital growth. So you buy it, let's say, in $500,000, and you expect them going to double in 10 years, let's say.
Which is the myth that people always go through when it comes to buying property. They're expecting, property double in value within 7 to 10 years.
Anyway, that's capital gain. But the thing is, then you may have a negatively geared or cash flow. What it means is each week you get the rent, you pay the interest for the bank, and the rent cannot cover the interest plus the maintenance or the cost associated with that property.
It's not just the interest, like either if you're doing principal and interest repayment or interest.
You just can cover it anyway.
Pretty much mortgage repayment.
Yeah. I'll say back in the days, maybe 10 years ago, you can find something capital gain with cash flow maybe. But anyway, so capital gain means in future the property price will go up, but you don't know when and you don't know how much. You cannot control it. The next one is cash flow. Cash flow, majority of them may be the out of the city, the regional, yes.
Country
they got good return because people couldn't buy the property in there. They're willing to rent, so the rent is higher. You can cover the cost of holding that property.
Yeah.
So that's cash flow. So which strategy is better? Depends on you.
Depending on your circumstances as well.
Yeah.
We did both. In the beginning, we were going to the capital growth.
Yeah.
Because
that's what we know.
Yeah, that's what majority of information out there. You look for capital growth.
And we couldn't find anything. We wanted to buy in Sydney Metro. We bought ours in Sydney Metro, but we couldn't find any with a positive cash flow.
Correct.
Property. So we bought that for capital gain, and we were working full time with our kids, so it was easy for us.
It was easy because the repayment on the property require coming up from our job. So we work, our mortgage repayment, let's say $200 per week. Sorry, $500 per week. Let's say mortgage repayment.
Yeah.
And then the rental is $300 per week. So it's out of pocket $200 per week. So that's the sort of the scenario that we were in. We're looking at that very first one that we're doing together. It was okay when you have a full-time job, when you have both income earning a lot of money, like more
you
than
have surplus.
Yeah, I mean, $100 here, $100 there is great. I mean, it's okay because it doesn't feel like it's hurting you because you know you're gonna get a paycheck the following week. Capital growth, and if there was a damage in the property, it's okay, you'll fix it because you still have hoping. Well, I was hoping anyway, it's gonna be doubled within 7 years.
Yeah.
Within 7 to 10 years, it's okay. I'll fork out this extra $10,000 or $20,000 to do renovation. Reality.
Actually, that property's been 7 years.
It has been 7 years. Has it doubled?
No.
No. So
It's in Sydney Metro.
In Sydney Metro, we bought it. What was it?
Somewhere
yeah, 400.
No.
300 something.
328,000.
Yeah, 300. Let's say 400.
Yeah.
Okay. So in today's rate, it should be double. So
It's
that would
700.
mean it should be at 7.
Yeah.
However, at the last price point that I saw, which is less than 12 months ago, it's still at the 5 something.
Oh, I
So-
thought before.
Oh, it's about higher 4s, not on the higher 5s. It's like 5 within the street, within the vicinity of the same configuration, 3-bedroom and 2-bathroom type of property, in the same street, in the same area, in the same postcode. So the myth of having property double every 7 to 10 years, if you believe in that, good for you, but we don't. Which one do you prefer?
Still depends on your strategy. If you're high income earner, you got too much money going, like paying tax, check with the accountant. If you just have too much surplus, then I think capital growth is okay. It's just kind of saving account, but the risk is, what if you don't have a tenant? You just cannot afford it. And now we change our strategy to cash flow because we can't really afford for maybe more than 2 of our properties got empty. They're vacant.
You can only hold so much. You can only hold so much when you have
multiple investment properties.
Yeah, and if it's taking out, in our case, it was about $100 per property, let's say. Yeah, at a certain level, I think it was like about 4, something like that. We were capped out. You know, if one property minus 100, another one minus 100. By the time you hold 5 property, you're pretty much already $500 per week.
Well, that's only when that's tenanted.
Yeah, that's
What
only
if
if it's
it's not?
tenanted.
What is vacant?
Which what we experienced.
Yeah, let's say you have 5 and then 2 of them are vacant. So you gotta fork out that $500 plus whatever rent they've been paying, let's say $300 a week per property.
In our case,
that's
it was about
$600.
$300 per week.
Yeah, so it's plus 600. 600 plus the 500 is $1,100.
And then what if they damage the property, which is what happened to us? It cost me to fix the property roughly an extra $10,000 or so.
Yeah.
10 something thousand.
Vacant for a month or 2.
Vacant for a month, a renovation, and I have to pay the mortgage repayment. So that's $1,100 a week or something.
And the rent, I think we have to go down for the rent to get more interest to rent the property.
So
even
not
though it's
only
renovated.
out of pocket every week about $1,000, I have to be out of pocket another 10,000 for the renovation. While it is being renovated, obviously I don't have any money. I don't have any income from that. I have to pay off that mortgage of about $1,000 per week.
Yeah, from your job.
From my job. Now that's great if you have 2 income that can produce more than $1,100 per week. But we were down to a single income.
Yeah.
So I stayed at home mum, and I had to do everything wherever it takes in order for me to sustain the property, and that's not good.
It's quite stressful.
It will be really stressful for whoever the breadwinner is.
Yeah.
So
a lot of argument because I was like, oh no, it's not much, you can do it, and you like money in, money out, and I'm holding all these property for what? When can I sell it?
Yeah, it got up to this stage like, this is not life, this is not what property. I felt like I'm being trapped. I'm like working but with no ending, and there's no way out.
Yeah.
So from there I had to change my strategy. You know what, this capital growth thing is not working out for me. Like, it might work for other people,
Yeah.
but personally for me, my own personal experience, it didn't work for me. So I had to change the strategy. So I looked at how can I make this into a cash flow type of property. So we still hold the same property now. It has been 7 years, huh?
Yes.
Let's say the first 2 or 3 years, it was
Yeah.
just a normal,
Traditional way?
traditional
Yeah.
way of that we were out of pocket of $100 per week. But now we are plus 300.
Yeah, plus 300 a week.
Yeah, plus $300 per week on that single property, and we're still holding it. The good and the bad on doing what we're doing. What are the goods, man?
Well, cash flow.
Every week we're gaining $300 per week.
Just from that property, yes.
Just from that one
We
property.
don't have to pay the maintenance, the buyer tenant buyer.
Yeah, we don't have to
They
pay
pay for
any maintenance expenditure, like your water rates, council rates, not strata.
No, a house. There's no.
It's a house because it's a strata.
Water, council, they pay for it.
Insurance.
Yeah.
We don't have to worry about anything that broken down inside the property. We care about the repayment side.
Yep.
We care about every week we're going to be earning more than what we're paying to the bank.
That's the good thing.
The bad news.
Bad news. You lock in the sold price. Your capital gain is locked.
Yeah, your capital gain is capped at a certain level. You can't have, well, in our strategy, you can't have both. Well, yes or no?
Yeah, yes and no, but just don't be greedy.
Yeah. For us, we look at cash flow every week. How much is it going to be bringing us for the next 30 years? Oh, that's the other bad news. It's capped, so you're capped at a certain level.
Yeah.
For instance, for us, it was like we're buying it at let's say 400.
Yeah.
And then we're locked in at 500.
Yeah.
And we capped at that. If tomorrow, in 10 years' time, it will go to $1 million, which is the doubling every 10 years. But we capped at that 500.
500. Yeah.
What else? What's
Well,
the bad?
I think that's the main bad thing.
It has an expiry date
It
of
has.
30 years.
Oh yeah, 30. But well, they can refinance you early.
So with our system, it has an end date. Whereas if you just buy and hold and hold and hold, if you pay in full, there's no end date.
No, it's yours forever. Yes.
Correct. So those are the pros and cons. So do we believe in capital growth?
Yeah, takes longer than that. Yeah, but it will go up because there are higher population, people trying to move in closer to the city before COVID.
Yeah, and then the infrastructure. There's a second airport in Sydney, so it's sort of in that between area.
Yeah.
Now when we bought it, we didn't even know about the second airport. That wasn't.
Not the plan.
That wasn't the plan.
there.
That was just buy and hold, renovate, buy and hold, and that's it. Buying and hold, it's great if you can make the repayment. But circumstances change. What if you lost your job? Buy and hold is great if you have a surplus cash. If you have an extra money lying around not doing anything, then yeah.
If it's you paid off, buy and hold. You pay off your mortgage.
If you buy it in cash with no debt, with no mortgage,
Yeah.
which what we have.
Yeah, one of them.
So that's great because that would be forever. We'll be earning.
Yours.
Yeah, it will be. What is it, like the goose that laid the golden egg? So every week we get a golden egg.
If there's a tenant.
If there's a tenant.
Yeah.
If there's no tenant, then it will be a liability then.
Yeah.
Anything else?
No, that's it.
So this is just give you guys an insight on what we
Think about capital growth compared with cash flow.
hopefully it gives you guys an understanding of it.
Yep.
Don't forget to subscribe, and I'll see you guys in the next video.
See ya. Bye.